Cathie Wood's rise and the emergence of Ark Invest represent a sharp break from the traditional image of Wall Street authority. Where legacy financial power was built on caution diversification and incremental change, Wood positioned herself openly on conviction concentration and long-term belief in technological disruption. Her story is not simply about performance, but about narrative timing and the risks of standing far away from consensus in a system that rewards conformity most of the time and punishes it brutally when patience runs out. Cathie Wood did not begin her career as a disruptor. She was trained inside the conventional financial system, working at firms where risk management diversification and benchmark awareness were central disciplines. This background matters because it explains why Ark Invest was not born out of ignorance of traditional finance, but out of deliberate rejection of what Wood came to see as its limitations. She believed that institutional investing had become too backward-looking, too anchored to indices, and too fearful of volatility to capture the full upside of exponential technological change. The founding philosophy of Ark Invest was radical by industry standards, but internally consistent. Wood believed that innovation follows nonlinear curves and that traditional valuation models fail to capture this reality. Technologies such as genomics, artificial intelligence, robotics, blockchain, and electric vehicles, in her view, were not incremental improvements, but platform shifts. If this was true, then diversification across slow-moving industries wasn't safety, but dilution. Ark's concentrated portfolios were a direct expression of this belief. Risk was not something to be minimized evenly. It was something to be embraced selectively, where disruption was strongest. What truly differentiated Ark was not just its holdings, but its transparency. Ark published daily trades, open research, and bold forecasts. This was unprecedented. Traditional asset managers guard information closely to protect perceived edge. Wood did the opposite. She treated research as a public good and narrative as part of the investment process. This openness attracted a devoted following, especially among younger investors who felt alienated by opaque institutions. Ark was not just an asset manager. It became a movement built on accessibility storytelling and intellectual confidence. This approach worked spectacularly during periods when innovation was rewarded. In the late 2010s, and especially during the pandemic-driven market environment, Ark's performance exploded. As capital flooded into growth assets and interest rates fell, the long-duration bets embedded in Ark's portfolios soared. Cathie Wood became a financial celebrity, frequently appearing in media, praised as a visionary who understood the future when others did not. For many investors, Ark symbolized a generational shift away from conservative finance toward belief-driven investing. Yet embedded within this success were the seeds of future vulnerability. Concentration amplifies outcomes in both directions. Ark's portfolios were highly sensitive to interest rates, liquidity conditions, and sentiment toward growth. While Wood acknowledged volatility as the price of innovation, the real test of her philosophy was never during exuberance, but during reversal. Financial history shows that conviction strategies are easiest to believe in when they work and hardest to maintain when conditions change. Part 1 of Cathie Wood and Ark. Invest's story is therefore about emergence. It is the story of a manager who challenged orthodoxy, embraced narrative openly, and captured the imagination of a market environment uniquely suited to her thesis. It is about how disruption, when aligned with macro conditions and cultural appetite, can transform an outsider into a symbol of the future. But it is also the setup for a deeper examination, because disruption in finance is only proven over full cycles, not moments, and the meaning of Ark's experiment cannot be understood without examining what happened when the environment turned and belief was tested rather than rewarded. Because the real measure of disruption in investing is not how a strategy performs when the world agrees with it, but how it behaves when the world turns against it. Part 2 of Cathie Wood and R. Invest's story unfolds during this phase when interest rates rose, liquidity tightened, and the market's tolerance for long-duration narratives collapsed. This is where conviction strategies either mature into enduring frameworks or reveal their structural limits. As inflation surged and central banks shifted toward tightening, the environment that had fueled ARK's rise reversed sharply. High-growth, innovation-focused companies, many of which depended on future earnings rather than present cash flow, suffered severe drawdowns. ARK's flagship funds declined dramatically. The same concentration that amplified gains now magnified losses. Cathie Wood remained publicly consistent, reiterating long-term targets and defending the thesis that innovation would ultimately prevail. This response itself became controversial. Supporters saw discipline. Critics saw rigidity. The core tension in ARK's second phase is between conviction and adaptability. Wood argued that innovation cycles span decades and that short-term drawdowns were irrelevant to the ultimate payoff. This view is internally coherent, but finance imposes an external constraint. Capital is not patient by default. Investors experience losses in real time, regardless of time horizon. The challenge for any conviction-based strategy is not intellectual consistency, but capital retention. Disruption that requires unwavering belief must also survive redemptions, sentiment shifts, and changing macro regimes. Another important dimension is the role of narrative. ARK's transparency, once a strength, became a double-edged sword. Daily trade disclosures and bold forecasts kept Wood in the spotlight, but they also intensified scrutiny. In downturns, visibility accelerates judgment. Financial celebrities built on narrative face a harsher feedback loop when narratives break. The lesson here is not that transparency is wrong, but that narrative-driven strategies carry reputational risk that compounds alongside financial risk. Cathie Wood's experience also highlights a broader issue in modern investing, the collision between long-term vision and short-term platforms. ARK's investor base included many individuals whose risk tolerance and time horizon did not match the strategy's volatility. This mismatch magnified pain during drawdowns. The story becomes less about whether Wood was right and more about whether the structure of modern markets allows such strategies to be implemented sustainably with public capital. From a historical perspective, ARK Invest fits into a long lineage of thematic and innovation-focused funds that shine brightest during specific eras. Some eventually evolve into durable institutions. Others remain tied to the cycles that birthed them. What determines the outcome is rarely ideology alone. It is governance, risk management, communication discipline, and the ability to adapt exposure without betraying core beliefs. Cathie Wood's greatest contribution may not be performance itself, but the debate she forced onto the industry. She challenged index worship, questioned traditional valuation, and reintroduced the idea that belief, when backed by research, can be a legitimate investment posture. At the same time, ARK's volatility serves as a reminder that disruption does not eliminate financial gravity. Markets eventually demand cash flow resilience and humility before macro forces. In the end, Cathie Wood and ARK Invest represent both the promise and the peril of disruptive investing. They show what happens when conviction meets the right moment and what happens when that moment passes. Whether ARK's story resolves as a temporary phenomenon or a long-term institution remains an open question. But its lessons are already clear. Innovation investing requires not only vision, but structures that can survive disbelief. Disruption must be paired with durability, and belief, no matter how sincere, must coexist with risk management strong enough to endure when the future arrives later than expected.